It was a day of mixed signals on Wall Street as investors grappled with a confluence of factors. The Dow Jones Industrial Average eked out a gain, rising by a marginal 0.2%. However, the S&P 500 slipped by 0.3%, dragged down by weakness in the tech sector. The tech-heavy Nasdaq Composite bore the brunt of the selling pressure, tumbling by 1.1%. On one hand, a robust earnings season has provided some reassurance about the underlying strength of corporate America. However, persistent inflation and the prospect of further interest rate hikes from the Federal Reserve are weighing on sentiment. Traders and investors are closely monitoring economic data for clues about the trajectory of inflation and the Fed's policy path. The CBOE Volatility Index, also known as Wall Street's fear gauge, spiked higher, reflecting the heightened anxiety among investors. The tech sector was the biggest loser on the day, with the Nasdaq Composite suffering its worst decline in weeks. Chip-making giant ASML plunged after reporting disappointing earnings guidance, citing softening demand. The news sent shockwaves through the semiconductor industry, dragging down shares of Nvidia and ARM holdings. Higher rates increase borrowing costs for growth-oriented tech companies, many of which rely heavily on debt financing to fuel their expansion plans. Apple, Microsoft, and Amazon, the three largest companies by market capitalization, all closed in the red, weighing heavily on the major indices. The FANG stocks, a group of high-growth tech companies that have led the market higher in recent years, were among the worst performers. As investors become more risk-averse, they are rotating out of growth stocks and into more defensive sectors. The financial sector presented a mixed bag, with some banks benefiting from rising interest rates, while others grappled with concerns about slowing economic growth. Goldman Sachs surpassed earnings expectations, driven by strong performance in its investment banking and trading divisions. Bank of America, on the other hand, reported a decline in profits, weighed down by provisions for credit losses. Higher interest rates typically benefit banks by boosting their net interest margins, which is the difference between what they earn on loans and what they pay on deposits. However, rising rates can also slow economic growth and increase the risk of loan defaults, which can hurt banks' bottom lines. Section 4. Energy sector. Shines, tech lags. The energy sector was a bright spot on an otherwise gloomy day for the market, buoyed by rising oil prices. Crude oil futures climbed above $85 per barrel, boosted by supply concerns and strong demand. The energy sector has been one of the best-performing sectors this year, benefiting from the surge in energy prices. The tech sector, as previously mentioned, continued its downward trajectory, weighed down by concerns about slowing growth and rising interest rates. The rotation from growth to value is being driven by a number of factors, including rising interest rates, slowing economic growth, and geopolitical uncertainty. Section 5. Standout performers and notable mentions. While the broader market was mixed, several individual stocks stood out as notable winners and losers. Boeing soared after the aerospace giant announced a major order for its 737 MAX jets from a European airline. United Health Group, a healthcare behemoth, rallied after reporting better-than-expected earnings and raising its full-year guidance. On the losing side, Tesla continued its recent slide, tumbling by over 5% on concerns about slowing demand for electric vehicles. These individual stock movements underscore the importance of bottom-up stock picking in a volatile market environment. Section 6. Economic headwinds and market outlook. The stock market is facing a number of headwinds, including persistent inflation, rising interest rates, and slowing economic growth. The Federal Reserve's aggressive monetary policy tightening campaign has weighed on asset prices this year, and the central bank is expected to continue raising interest rates in the coming months. Despite the challenges facing the economy, many market strategists remain cautiously optimistic about the outlook for stocks. They point to the strong labor market, robust consumer spending, and healthy corporate balance sheets as reasons for optimism. According to Bob Desmond, a veteran market strategist, we are in the midst of a sector rotation, with investors moving out of growth stocks and into value stocks. He also notes that specific stock performance is becoming increasingly important in this market environment.